Good morning. These are the things that matter most in Europe's market today. China's robotics boom has moved from concept to market signal. Long yields are still tightening the quality test. Oil remains a margin risk, and tariff headlines are no longer background noise for exporters. The central question is simple. Can Europe keep rewarding AI and industrial technology if higher rates, energy costs, and China competition force investors to demand proof instead of stories? Start with China robotics. CNBC reported that Unitree, the Chinese backflipping robot maker, jumped 542% in its Shanghai debut. That is not only a spectacular IPO headline. The hidden mechanism is automation credibility. China is trying to turn robotics, electric vehicles, and AI hardware into a single industrial advantage. For Europe, the cleaner side is Siemens, Schneider Electric, and ABB, where factory automation, power systems, and industrial software can turn automation spending into real orders. Pressure sits with machinery and car companies that face China as a lower-cost competitor rather than as a demand engine. For private investors, the filter is proof. A robot stock jumping in Shanghai does not make every European industrial name investable. The useful question is whether European automation leaders show order momentum, pricing power, and margin resilience, while China proves faster deployment. Second, oil and yields are still tightening the market map. CNBC's daily open-framed robots, tariff turnaround, and yield nerves together. CNBC also reported the 30-year Treasury yield above 5.33%, and Investing.com said U.S. futures dipped after Wall Street was hit by higher yields in oil. Yahoo Snapshot has Brent around $91 and the VIX higher than yesterday. The cleaner side is Shell, Total Energies, and BP if crude keeps supporting cash flow. Pressure sits with Lufthansa, IAG, and Ryanair if fuel costs become a margin tax, and with long-duration growth stocks when higher yields reduce the value of future cash flows. For private investors, the takeaway is that oil and yields are not separate stories. They decide whether the market rewards current cash flow or punishes companies that need cheap financing and stable input costs. Third, tariffs paused but did not disappear. CNBC and MarketWatch reported that President Trump held off on planned 50% tariffs on Canadian goods for 3 days after announcing a deal with Ottawa. For Europe, Canada is not the whole story. The hidden mechanism is negotiation risk. Global supply chains can reprice before the final policy is known. The cleaner side is companies with local production, flexible sourcing, and strong pricing power. Pressure sits with car makers, industrial exporters, and suppliers that depend on smooth North American trade routes or imported components. For private investors, the practical filter is not whether one tariff deadline moved by 3 days. It is whether trade-sensitive names behave as if uncertainty is fading or as if customers are delaying orders until policy is clearer. Fourth, Europe's platform regulation story remains alive. CNBC reported that Apple overhauled Europe App Store fees to resolve a payments clash. That is an Apple story, but it is also a Europe market structure story. Regulators can change the economics of distribution, payments, and digital services. The cleaner side is not simply anti-Apple. Potential beneficiaries include payment and software names that gain when distribution becomes more open, while pressure can sit with platforms whose economics depend on closed ecosystems and high fees. For private investors, the filter is cash flow conversion. Regulation can sound important, but the market needs to see who actually gains revenue, volume, or margin from the new rules. Here is the stock-led watch list. Siemens, Schneider Electric, and ABB test whether robotics becomes European automation demand. ASML, Infineon, and SAP test whether AI spending reaches Europe beyond the headline. Shell, Total Energies, and BP test whether oil is cash flow support. Lufthansa, IAG, and Ryanair test whether the same oil price is a margin tax. Volkswagen, BMW, and Stellantis test whether tariff and China competition pressure is already priced in. Market bias, selective and proof-driven. Europe can absorb noisy headlines if quality companies show orders, margins, and cash flow, but the index setup is weaker when robotics, oil, yields, and tariffs all point toward higher selectivity. The mistake to avoid is treating every technology headline as a broad Europe signal. The better filter is company-level proof. Who owns the automation layer, who pays for energy, and who can defend margins when policy risk returns. That is the Europe Morning Market Brief. We will be back tomorrow at the same time with everything that matters. Research context only. This briefing is not investment advice.